Do you own an investment property that you plan to sell and want to use the proceeds to make a larger investment? Did you know that there is a program that allows you to invest those monies as equity rather than paying taxes on the sale proceeds when they're not required? This program is called a tax-deferred exchange. Sellers of investment real estate in the United States can exchange it for other like-kind property without paying federal income taxes under Section 1031 of the Internal Revenue Code. Let's take a look at the 1031 exchange program. Stay tuned. Hello everybody, Maya is here with Monument Sotheby's International Realty here in beautiful Howard County, Maryland. And today let's talk about Section 1031 tax-deferred exchanges for real estate in US. Did you know that instead of paying taxes on the revenue of sale that are not required, those money can be invested as equity? If seller owns residential or commercial real estate investment property that is being sold and seller intends to acquire investment property again, there may be a viable option called a tax-deferred exchange program. The Internal Revenue Code Section 1031 permits taxpayers to exchange real estate in the United States held for investment or for use in their trade or company for other like-kind property without paying federal income taxes. And almost every state's tax code allows for this. Although there are technical regulations and deadlines for completing the exchange, it is a simple process with well-defined rules that are expressly permitted by law. All capital gain taxes, all depreciation, recapture taxes, all passive investment taxes, and in most situations, state income taxes can all be delayed. These taxes can mount up to more than 30%, and because of this, it may be more advantageous to reinvest the money in a like-kind property and continue to earn investment return. So how to define a like-kind property? The term like-kind property is frequently misinterpreted. Some may be surprised to learn that definition is considerably wider and simpler than they think. Essentially, any real estate that is held for investment or use in the taxpayer's trade or company in the United States can be traded for any other U.S. real estate which is held for investment or used in the taxpayer's trade or business without paying taxes. So for example, apartment building can be traded for a warehouse, retail store or farm, or shopping center could be built on unoccupied property retained for investment. Also, if you have a non-primary residence that fulfills the 1031 exchange conditions and it's used as an investment, that property can be exchanged into a commercial property. The actual use of the real estate is not what makes it like-kind to other real estate in the United States. Rather, all real estate in the United States is like-kind to all other real estate in the United States. And of course, foreign real estate is excluded. The real estate being sold must have been held for investment or for use in the taxpayer's trade or business. Also, the real estate that is being bought must be held for investment or for use in the taxpayer's trade or business as well. So what are the time constraints? The taxpayer does not need to know exactly what property will replace the property being sold at the time of closing. The taxpayer has 45 days to discover suitable replacement property and up to 180 days to buy it once the sale is completed. However, during the exchange period, the selling taxpayer cannot take physical or constructive ownership of the sale profits. And to meet this requirement, the seller will choose a competent intermediary to hold the money under the terms of an exchange, trust agreement. If required, this can be done rapidly, generally within a day or two before the closing date if needed. Although the seller taxpayer does not have access to the money during the exchange period, the seller taxpayer does have the authority to instruct the qualified intermediary to use the funds to acquire any replacement property that the taxpayer identified during the 45-day identification period. Now, to postpone all taxes, the wholesale profits from the sold real estate must be utilized to purchase the replacement property. All cash received at closing, as well as any mortgage debt that was paid off, are included in the definition of sale profits for this purpose. So, what are the benefits? There are several benefits and not many drawbacks to arranging a transaction as a tax-deferred exchange. The regulations are very technical, yet they're easy to follow. It has no impact on the buyer while providing enormous benefits to the seller. As always, in a scenario like this, you should contact your financial advisor, your CPA, and of course call me for assistance in identifying like-kind exchange properties. You need your trusted real estate advisor with this. Of course, if you have any questions regarding real estate or architecture, because remember, your agent is also an architect, please reach out to me at 443-850-9968.